What is going on, guys? What is going on? So the Fed announced that they were doing a 75 basis point rate hike. This is what was priced in. This is what we thought would happen. And now we're about to listen to Papa J. Powell actually give us some more detail.
I will begin with one overarching
So
message.
I'm going to turn myself down and we can
We at the
listen to
Fed
this.
understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Howard Schneider with Reuters. Two related questions.
All right, we'll listen to a couple of these questions and see if they're relevant.
Which you used at the last press conference on 50 basis point hikes in June and July. And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So As you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, and we thought, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Okay, Gina?
Thanks for taking our questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have, and why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up expeditiously to more normal levels, and we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year. And that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are. And that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seemed like the right thing to do at this meeting, and that's what we did.
Steve.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year, do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5% to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask, all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand, and that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I think I would think about it.
But does 3.8%, 4% get it done? Does it get the job done of breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days, so I would think it would. But you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thank you, Dan.
All right. Do you want to hear more questions, or I can give you my commentary on what was said so far, and then answer your questions? Let me know if you wanna hear more of Powell's answers to the reporters' questions. I'll turn it back on. If not, I'll give you my breakdown and then answer your questions. Let me know.
I'm wondering, on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal?
All right, you guys spoke. You want to hear my commentary? Okay. So I'll just give you a TLDR version right now. TLDR means too long didn't read. So the Fed raised rates by 75 basis points. This was the biggest raise since 1994, the biggest single raise since 1994. And basically what Powell said was that, they had initially thought about 50 basis points, like everybody thought, and then they actually leaked it to the press. And I talked about this in my last video, not my last live, but my last video, about how this went 1 week from a 3% chance that they raise 75 basis points to a 96% chance that they raise 75 basis points. And it's because the Fed is so good. This Fed specifically is so good at telegraphing their moves so that they don't really cause an effect in real time to the market. So the Fed leaked to the press that 75 basis points was likely going to be what was needed, especially after the CPI came out higher than expected last week, showing that the inflation is on an upward trajectory, which the Fed definitely didn't want to see. The core CPI went up, PPI went up as well. That's the producer price index. So all of that led to the Fed leaking to the press that they were thinking about a 75 basis point rate hike. And then you obviously saw it in the Fed funds futures here, where it was, almost 100% that the Fed was going to do a 75 basis point rate hike. And so in my last video, I said that, if the Fed doesn't do a 75 basis point rate hike, it will signal to the market that they are not serious. So if somehow they came out today and just stuck to the 50, I think the market would have tanked. And if they came out today and went to 100 basis points or more, it wouldn't have been more. But if they did a full percentage, I think that would have caused panic in the market as well. So 75 was priced in, and 75 is what was needed for the markets to not tank today. And this is part of the reason that we actually bought puts on the VIX. So not only from a technical perspective, and for those of you that are in the Discord, you saw this yesterday. I actually also sent it out on Twitter just as a freebie. But I said yesterday that I was buying the VIX 30 puts after seeing this bearish harami candle here. And then I examined all of the last FOMC meetings in 2022. And after every single FOMC meeting in 2022, we had a tanking in the VIX. The VIX obviously is the volatility index. This is based on S&P 500 options, right? And it's basically an expectation of volatility. So if 75 basis points is what's expected, and the Fed actually comes out and raises by 75 basis points, then the VIX is going to tank because there's no expectation of volatility. What was actually priced in is what happened. So I went ahead and did that. We are now up 30% on these puts. That was a really easy money play, in my opinion. And then obviously the other analysts had a bunch of day trades going, playing the volatility today, the up-down movement that we saw in the markets. If you're monitoring this stuff intraday and you're experienced, some of these moves are fairly easy on these binary events, especially when big moves are priced in. By the way, in terms of our trading academy, we have closed it as of now, and the only way to get in is to apply. However, there is a new model here where you get access to the entire Discord, all of the options alerts, long-term stock alerts, etc., as well as the chats, but then you also get access to all current and future courses as well. So it's part of a larger package, and you will see that link in the description. So you have to actually apply in order to enter. That's how we keep the group small and tidy. And yeah, anyway, let me take your questions here. But if you're interested, check out the link in the description. It's just thetravelingtrader.com. Why are you so good at this? You're the champ, man. Honestly, I mean, it's just experience. It's living and breathing this stuff for decades. But that's not to say that obviously I don't make wrong calls or wrong trades. It's just avoiding non-optimal trades, right? So somebody had asked me today if there were still legs left in an energy trade. And, although there might be legs left in an energy trade, to me, that's untouchable because, it's not an optimal trade here. There's more downside in the future than upside, or at least there's more of a possibility of stagnant price action than major upside in energy here. So it's really avoiding non-optimal plays and then being able to recognize what is an optimal play, and then doing a lot of back testing and studying, paper trading, writing down your trades, journaling. It's all, it's like anything else. You want to get good at chess or golf or basketball. It's just living and breathing this stuff day in and day out. All right, so 75 basis point rate hike. So what else did Powell say that was important? Powell said that, and this is why the markets started rallying, is because not only did he come out with a 75 basis point rate hike, which is what was expected, but he came out and said that, what were his exact words? He said he doesn't expect 75 basis point moves to be common in the future, although he's not ruling them out entirely. So he's basically saying that it is an extreme measure that they will only deploy as needed after monitoring the economic situation. And say CPI comes in even higher next month, right? Say it comes in at 9%, then you can expect a 75 basis point rate hike. Otherwise, don't expect that to be the norm, is what he said. That is what caused the VIX to tank further. That is what caused the markets to rally some more. So that's essentially what he said. 75 basis point rate hike. Don't expect that to be the norm. He sees, in terms of projections, the first declines in interest rates in 2024. So for those of you that are planning to buy a house this year or, within the next few months, look to potentially 2024 to refinance, right? Once the rates start dropping again. This obviously is, 2024 just seems like so far in the future. We don't know what's going to go on. Are we going to be in a recession, et cetera? And then he said that the target rate is 3.4% end of this year. I think initially they had targeted 2.9% for the Fed funds rate, but now they're looking at 3.4%. So speaking of GDP, here is, what could actually put us in a recession by July. So we got a negative GDP reading for Q1. Q2 GDP reading comes out July 28th. And right now, looking at the GDP models, just today, the model had slipped to zero growth. So 0% growth, which obviously doesn't give us a huge margin of error and could easily put us in negative territory. If the margin of error is just, 0.01% or greater, that could easily put us in a negative GDP scenario, which would then put us officially in a recession. Now, recessions are lagging indicators. So what we've seen in the past, aside from 2008 and the year 2000, is that recessions can actually, once the recession is official, the market can actually be closer to a bottom at that point. So unless this is a scenario where we have a huge default risk like we did in 2008, signaling a recession doesn't mean that the market is going to drop another 30% from here. So just keep that in mind. All right, let me get to your questions. Market will tank. Whatever fake rally you will see is just for huge found selling their stock. Don't go in. I'm not saying go in. I'm not saying go in at all, Mazen. I'm just saying that the market is rallying right now because of what was priced in. There isn't reason for the markets to have a sustained rally because there isn't an answer to price instability. And price instability and inflation is wreaking havoc on the economy, which in turn is wreaking havoc on the companies in the stock market, right? So until there's an answer to whether inflation can be controlled or not, I agree with you. I don't think this is the time to go in heavy. So yeah, I at no point did I say, this is a sustained rally. I'm just telling you what's going on right now and my reasoning for opening puts on the VIX, as well as some of the other day trades in the elite trading group, where we were playing the swings intraday on the indices. That's all. So hopefully that makes it clear. I do think, if you want me to go over what I think is possible for the S&P 500, we did hit official bear market status, and I did show it in my last video. I don't want to go digging for it now, but the average bear market, once the S&P 500 hits bear market territory, the average bear market lasts 11 and a half months, so almost a year. And I can easily see the S&P 500 falling to the 3,500 level, which would be another 6-7% drop from where we're currently at. So I do see the the S&P 500 falling near 30% by the time this is all said and done. And then obviously, if CPI comes in and it now is trending lower and it looks like there's an end to the inflation problem, then I think the markets will be closer to a bottom at that point. But then remember, all the market cares about at the end of the day is how does what is going on affect the company's earnings, and will companies continue, is there a healthy environment that companies can continue to grow? And is there a healthy environment where companies can actually now have realistic and sustained guidance projections, right? So until we get to that point, I agree with you, Mazen. I don't think this is a heavy buying opportunity. The investor squad, so rally or is the market going to dump? I mean, these are very rudimentary, somewhat childish questions, because it depends on what you're talking about. If you're day trading, then you obviously are going to be asking this question on a day-to-day basis, and you're going to be trying to play the levels that you see. But when you say rally or is the market going to dump, what is your time frame? Yes, I mean, the market will rally and the market will dump. So it's much more efficient, I think, to talk about levels and the possibilities of the indices or stocks hitting those levels in the midterm, and what does the macroeconomic picture represent, and how does that affect stocks and the companies on the stock market. Rally or dump is not really a valid question, to be honest. It really depends on the time frame. All right. My puts are getting crushed. Yeah, I mean, there would be no reason to buy puts here, Alvin, honestly, unless you were day trading, and unless you're day trading and you're looking at, levels intraday, and, you're buying puts and calls at support and resistance here. There's no reason to buy puts after a binary event where, everybody and their mom knows what's priced in. I don't see the reason to buy puts unless, Alvin, you had a really strong conviction that the Fed would raise by 100 basis points, or that the Fed would actually, cower and not do a 75 basis point rate hike. Otherwise, there's absolutely no reason to buy puts here, because all this stuff was priced in. So again, unless you thought that something wasn't priced in, and that would be the outcome, fine, maybe. But I would not have bought puts here. Now, if you're holding puts long term, that's a different story. Yes, you're going to get crushed in the interim, but it doesn't mean that, if you have puts held until the end of the month, it doesn't mean that your puts won't print. So yeah, but if you bought puts just for today, I don't like that play, to be honest. And that's why we didn't send out puts for today. And what I actually played was puts on the VIX, because I expected volatility to drop. Sonar, who joined the Discord? We have thousands of people who joined the Discord. A lot of them are here on the chat. So will it affect gold? I'm not really a gold trader. I don't care for gold. I don't think it's a good inflation hedge. I mean, if you have physical gold that you have stored away in a bank vault or something, that's great. But in terms of actually trying to trade gold and deeming it a recession hedge or an inflation hedge, I mean, just look at gold. Even during recession talks, even during, this period of extremely high inflation, gold is down 12% in the last, 3 months. So it's not the inflation hedge that people think. And just look at previous crashes and look how gold has reacted. It's not, I don't know why it has this perception that gold is somehow a safety net against a market drop. It isn't. The Discord is free to join. No, it is not. There are free sections of the Discord, yes. But if you're talking about the alerts, the chats, the analysis, the courses, the Zoom calls that I do with members once or twice a month, depending on the tier that you guys are in, there's really a lot of value there. It's an entire academy. So no, it is not, the whole thing is not free. All right. Best Discord. Appreciate you, Charlie. Gold is a good stagflation hedge. Maybe. Based on my research, during recessions, during market crashes, during inflation, gold is not a safe haven. It really isn't. And neither is Bitcoin, to be honest, right? So Bitcoin is a very, very good tradable asset. If you got it for cheap, it's a good store of value if you can stomach the volatility. But yeah. Hazy, what about the people who sub to your both websites? Not sure what you're talking about, OU, to be honest. If you're talking about people who are already in the Discord, yeah, they're grandfathered in for life. So I had mentioned that already. If you had joined the Discord at any point before we changed up the application process, yes, you're grandfathered in for life. It's just for new applicants or new members, they have to apply to the academy. That way we keep the community tight knit and provide as much value to members who want to be there. What would be the first solid catalyst you look for the market to stabilize and trade back up? This is a very good question, Stereo Hound. I really appreciate good questions. A few things. So I will tell you that what I'm monitoring right now, okay? Unemployment rate. So we're seeing not mass layoffs, but we are seeing quite a few companies, especially tech companies, starting to ramp up layoffs. Now, it's not at an alarming level. Unemployment is still low. However, as I've showed you before on this chart, these gray bars here represent recessions. And recessions usually happen after a period of historically low unemployment, but then we start to creep up in unemployment. So if the unemployment number starts going up, I think it's at 3.6% now. If we start getting to, say, 4% or higher, then the likelihood that a recession is near is very high. I'm also looking at the 10-year, 2-year yield curve that went negative again. The more times this happens, the closer we are to a recession. And then obviously, I'm going to be monitoring the GDP numbers that come out July 28th like a hawk if we get a recession there. So here's the thing. The minute that we fall into a recession, if it's going to happen this year, I'm going to be looking to buy very heavily because that drop, if a recession is announced, I figure that we'll get an overreaction in the market, right? That's the type of fear that you want to buy. So if you look at the indices, if you look at your favorite mega cap companies, and now they're down significantly after a recession is announced, that's when my buying antenna is going to start going up. Like I said, I aside from those metrics that will define whether a recession is imminent or not, another thing that I'm looking at is price instability and CPI. The minute that we start trending downwards on the CPI significantly, and we can get at least consecutive months of downward trending CPI, I think that will give the market the confidence that it needs to say that, okay, finally, the Fed did an aggressive raise of 75 basis points. They're starting to roll assets off of the balance sheet or letting assets off the balance sheet run off. Okay, we could see light at the end of the tunnel. So this is where we're going to support the market. I can see the S&P 500 get to that 3,500 range, which would represent near the pre-COVID highs. And I would be very interested in buying there if that confluence of metrics and indicators that I just discussed, come to fruition. But yeah, I do think there is some more downside, even though, we might see a small bear market rally here. But the minute that the S&P 500 falls into a bear market, the average bear market lasts 11 and a half months. So I don't think this is over yet. But I do think that there will be some insane buying opportunities, and that people that end up buying the fear here come, 4 or 5 years are going to look back at their portfolio and are going to be like, holy shit, I was finally able to take advantage of a recession. I was finally able to take advantage of a market crash. And now I see the dividends, not in the actual sense. I mean, the payoff from investing in quality companies when everybody was fearful. I do think that, you know, people who are steadfast here and that actually aren't going to retire in the next couple of years, you know, in 4 or 5 years, they will look back at this and be like, fuck, I really was able to buy, you know, Amazon at more than half off or Apple at 30, 40% off or whatever. So yeah, yo, our problems are still there. Sure. Not sure what you're talking about. Should have asked your FA. I'm staying variable. Not sure what you're referring to, Vito. FA, financial advisor, I guess. Hi, Z. What are you adding to your long term? I just talked about when I would look to add. I'm not adding much to my long term here. Just day trading, playing options, making money off of this volatility. Again, if the only thing you know how to do, is buy stocks and sit on your hands, you're going to feel max pain here, unfortunately. I'm not saying that you should not be having a long-term horizon, but you know, if the only thing you know how to do is buy stocks here, it's going to be max pain for probably at least a year. So, you know, be sure that you are patient and steadfast. But if you also want to make money here, you want to sell calls against your shares, you want to learn how to buy protective puts, set up, you know, bear spreads, if you want to learn how to play the VIX, if you want to learn how to day trade on a daily basis where you wake up neutral and you don't care what the market does because you're equipped with the tools to handle any market situation. I mean, I really, I really suggest that you guys join a community like ours, because people are learning that there's more than one way to bank, and buying stocks here and praying that they go up is not the way. You know, it's going to affect you psychologically, emotionally, and in the short term, financially. So, Hazy, what about, okay, I answered that already. 3,600 seems like a good bottom. Yeah, 3,500, 3,600, I could see there. I don't day trade. I sold 2/3 of my investments. To each their own, Andrew. Anyone can learn if they really wanted to. The problem is debt, whether people, companies, or countries. In this case, I don't think the problem is debt, Nuno. I think the problem is too much money chasing too few goods. It's not debt. The problem is cheap money. That's the real problem. That's the real problem. Do you still record your trades even today to go through what went wrong, right? Honestly, W, I do only if there's something that either I got really lucky on. You know, I don't try to rejoice and be like, oh, I'm a fucking genius. I acknowledge if I got lucky on something where I'm like, oh shit, like, you know, this completely went, it looked like it was trending the other way and I ended up taking a win on it. Or if I really made a blunder where I look back at a trade and I'm like, why did I do this again? You know, even after so many years of experience, I still experience that, right? So yeah, I do go back and look, but I don't look at every single trade because I trade so much. And at this point, it's like second nature to me. But yeah, it's just like driving, man. Like you don't go back and examine every drive that you have, but say you hit a fucking parking post or something, you know what I mean? Or you nicked a car in the Target parking lot, then you're going to go back and be like, wait, why did I do that? What did I do wrong? Or you avoided an epic accident, you know, by fucking driving like Mario Andretti, and you somehow avoided the trash can in the road. You're going to go back and revisit those moments. Same thing with trading, but otherwise on a day-to-day basis, it's very second nature to me. So I don't go back and look at every single trade. This is not the moment because we were all waiting. Not sure what you mean. Cheap to buy or not? Again, not sure what you mean. Unless inflation is still out of control. Yes. Yash, what's going on, man? FOMC, I need to learn options. You do. So do you think my puts will pay off? I have no idea what your puts are, Alvin. I have no idea what they are. I have no idea when you bought them. I have no idea what you paid for those premiums. Z, your shoulder size is lit, bro. Are you looking at my Instagram or you mean right now? If you can tell my shoulder size right now, that's very impressive, Kevin. That's very impressive. If you're talking about Instagram where once in a blue moon I post workout videos, okay, I could see that. But appreciate it. How do you feel about buying deep ITM year-out calls? I don't really like that, Dr. Jennifer. I don't like buying leaps here. If you can stomach the volatility, fine. But I know that buying leaps here is going to be cheaper than buying stocks for the equivalent amount that you can control with leaps, because obviously when you buy a leap, you control 100 shares. It's much cheaper than buying 100 shares of stock, but that also means that drops are going to be more violent for you. And I don't think that it's smart to buy leaps here, because I personally think that once the S&P hit official bear market status, there's going to be a lot of volatility and potential bloodshed. Now, I also want you to monitor the VIX. Make sure that if you are buying leaps, you are buying them when the VIX is at a recent low, so probably close to 25 or 20, because remember that when implied volatility is high, you're paying much more for those options than when volatility is low. But yeah, I don't like buying leaps here, to be honest. I would much rather sell cash secured puts, Dr. Jennifer. Much rather sell cash secured puts here, because you could sell cash secured puts very cheaply. So for instance, if you go out to, let's say that we go to QQQ, for instance, right? If you wanted to sell cash secured puts on the triple Qs to own 100 shares of the NASDAQ ETF, and you went out to, say, I don't know, the December options, you can sell cash secured puts on QQQ for relatively cheap. It's currently trading at 280. You could sell the 240 cash secured puts for $1,000, right? And this means that you essentially would have the chance to buy the triple Qs for $240 minus the $10 per share that you collected for this put, right? So essentially, if the QQQ hits 240 or below and you get assigned before December, then you get to buy the triple Qs for $230, right? And if you don't get assigned, then you keep $1,000 for every option that you sell. This is why being an option seller is much more lucrative than an option buyer. So if you have the money to buy leaps, I would probably suggest that you look towards selling puts as opposed to buying leaps, because 230 on the triple Qs represents a 43% drop from highs. Who wouldn't want to buy in any point in history the NASDAQ at a 43% discount? So I would much rather sell puts here, Dr. Jennifer Berry, than buy leaps. It is a much easier play. You get to rest your head at night because you don't need the stock to violently rally. You're not going to go through these day-to-day volatility jumps where if the market tanks, your leaps are going to be severely down. You can comfortably sell this 240 put and live with it, because if you never get assigned, you keep $1,000 per contract. Easy money, right? If you do get assigned, you get to buy the NASDAQ ETF at $230, and it's currently trading at 282. It's a much more optimal play if you have the capital. The only thing that stops people from not selling cash secured puts is the knowledge, because it requires a little bit of knowledge, and two, the capital, because it's expensive. But if you have the money to buy leaps, then you most certainly have the money to sell cash secured puts on some stuff. So, and you can apply this to stocks you want to own, whether it's Tesla, the SPY, Amazon, whatever. I would much rather sell puts. So hopefully that helps Dr. Jennifer Berry. And these are just some of the types of plays that we have in our elite trading group. And you can ask other members how to do this if you have no clue to do it. There's thousands of traders there that you can really rely on, and and that have your back. Don't go at this alone. All right. Hopefully that answers your question. What about Indian market tomorrow? Vimal Patidar. Hopefully I pronounced your name correctly. I always get questions about random markets, Russian market, Bulgarian market, now Indian market. I don't know. Unfortunately, I can only keep track of a few markets. 5'6", he's short. All right, fuck off. You know I'm not 5'6", motherfucker. Don't make me put you on blast, Omar. Don't make me put you on blast. A few people on this stream have met me before, and you definitely know that I'm not 5'6". You can just look at my pictures and tell. Can you box Tom Nash for charity? Jerry Avename says, ask him. Sure. I mean, he definitely is above my weight class, so I'm way around 170. I don't think he's around 170. I would definitely box anybody for charity, actually. Yeah, float it to him and let me know. You can be the promoter, Jerry. You could step in and be the Don King of the charity match. Is the rate hike positive for AMC? Has nothing to do with AMC. Wu-Tang is for the children. Yes. Bro, people be asking you questions like the genie in Aladdin. Amazing. Worst drivers live in Texas? I don't know about that. I've been to some pretty gnarly countries. What time does Clown Fed announce the hikes? They already did. Rewind the tape. We covered it here live. 75 basis points. All right, let's see. Z, you come into NY anytime soon? Yes, Yash. I'm actually going to be moving to NY for a month or so. So I will be there. July, sometime around July. All right. What does this rate hike mean for XOM? Guys, the rate hike doesn't mean anything for individual stocks. The rate hike really is more to do with the economy and not individual stocks in general, right? The rate hike is meant to remove liquidity from the economy, right? So it's meant to make buying a house more expensive. It's meant to make buying a car more expensive. It's meant to make borrowing money more expensive. It's meant to make starting a business more expensive. That's what rate hikes are meant for. Rate hikes aren't meant to somehow alter the price of AMC or ExxonMobil, right? It has nothing to do with that. Now, while the stock market, while the Fed is raising rates, usually the market tends to see declines, but that's, because of what's going on in the economy. Over time, the market, tends to rally during rate hikes. This situation is very different because the Fed is trying to raise rates during an economic slowdown. This is something that's never happened, but they have to do it because inflation is so high. So they have no choice but to raise rates in a slowing down economy. That's why everybody's criticizing the Fed, because coming out of COVID in 2021, around summertime 2021, when GDP was at a record high, that's when the Fed should have started to tighten monetary policy. Not let it run until 2022, once inflation took over, then tried to tighten monetary policy. So it doesn't mean much for these individual stocks that you're asking about. It's meant to curb inflation, and release the or pull back some of the money from the economy. Jennifer Paul, can someone ask him how tall he is? I'm 5'11". The rich get rich and the poor, stay poor. Unfortunately, that is the truth. So removing liquidity from the market doesn't affect shorts in the overall stock market. I'm not sure where you guys are coming up with these weird connections. What do you mean affect shorts in the overall stock market? Removing liquidity from the market, it's removing liquidity from the economy, right? Not the market. What's going on in the market, yes, is a reflection somewhat of what's going on in the economy, but the economy and the stock market are not the same thing. I think that, obviously if you've bought, if you were engaged in put buying all year, you made a shit ton of money. I would continue to engage in protective put buying here because I do think that the bear market status for the S&P 500 is not over. So yeah, I'm not really sure what you're asking with the link between interest rates and shorts. There isn't a direct link there. I'm new to stocks and I'm learning more. I'm not going to repeat this. Bro, specifically VXX put or buy, can you explain that? I have no idea what this question means. Specifically, this isn't really a specific question. VXX put or buy, can you explain that? Not sure what that means. 750 next week call on Tesla, worth it? Jay, that sounds like a very inoptimal gamble here. That doesn't sound like this is based on TA or whatever. I look at Z as the Dos Equis most interesting man in the world, but with nicer biceps and big lit shoulders. Oh my God. This is turning into a circus. Yeah. All right. Let's see. My portfolio was up 2% today before the Fed, and now it's up 4%. I hope I keep it for a minute. I mean, honestly, if you're looking at your portfolio on a day-to-day basis, you're going to keep, going in this roller coaster where, again, one day you're going to look and you're like, oh, holy shit, I'm up 4%. Tomorrow you're going to be like, damn, I'm down 2.5%. That's not really a way to look at it unless you're day trading. If you're day trading, then yes, you're going to look at your gains every day because you are making decisions every day. But yeah. All right. Isn't the inflation mainly caused by supply side shortages, which self-corrects? No, inflation is too much money chasing too few goods. Okay. So it is not mainly caused by supply side. It's caused by demand and exacerbated by supply side shortages. Okay. But there's incessant demand because there was incessant money printing. So when there's too much money and now it is chasing too few goods, you get inflation. So inflation is worse if there's an increase in demand and then a significant decrease in supply. The supply side shortages aren't because there's an increase, not solely because there's an increase in demand. Even if there wasn't an increase in demand, there would still be supply chain issues because of a lot of reasons. I mean, the lockdowns in China, COVID in general, the fact that there were things stuck at ports for the longest time. And then it's made worse by the fact that there's an increase in demand because of all the cheap money floating around. So yeah, what the Fed can control though, they can't control supply side. They can only control demand. And that's what they're trying to do with, increasing interest rates. They want people to stop buying things. Have you ever blown up an account? Never. I've never blown up an account. I don't see how that's possible. I'll be honest. Unless you open up like $1,000 Webull account and you're like, oh, I'm going to full port this and try to YOLO this into $100,000. Maybe. But if you're talking about like your actual portfolio or your actual account, no. I've never even gotten close to that. And you shouldn't. You honestly shouldn't. How to recover from it? Make fucking better decisions. Learn how to trade before actually going at it. Paper trade for months. Journal your trades. Paper trade is as if you were trading real money. Go over why you made the decisions you made. Why you had the losing trades you had. Why did you lose that much to where now your account balance is in jeopardy? Yeah. What interest rate do you think is required to reverse inflation? Honestly, I don't think anybody knows. Keep it real. I don't think anybody knows. Jerome Powell just said that their total target rate is 3.4% by end of this year. Is that going to do it? And that's what Steve Leisman from CNBC, who was part of the crowd of reporters that was asking him questions, he said, do you think 3.4% is going to do it? This is, the most violent inflation that we've seen in 41 years. And that was a valid question. And Jerome Powell said, we don't know, but we will continue to use the tools that we have as we go along. I have a feeling that we get a bear market rally starting today until the end of June. I mean, Dean, if it's just a feeling, then don't trade based off of a feeling. If you have data, technical analysis, you have an optimal play set up in order to back this up, sure. But if it's just a feeling, I don't know. I mean, I have a lot of feelings that don't pan out. Hey, Z, who do you got, Warriors or Boston? I've been asked this quite a few times, and I thought the Warriors would win. But yeah. Will the housing market go up or down because of the rate hikes? The housing market will stagnate at the very least. Whether we see a housing crash or not depends on the default. Currently, I don't see, based on the data, that we have any sort of risk that's comparable to what we saw in 2008. So I don't think that, we see a housing market crash, but we certainly see the housing market cool off. And I was talking to a realtor friend of mine yesterday here in LA, which was the most absurd housing market, literally number one during the post-pandemic period. LA was the worst place to buy a house because it had the least amount of inventory. And even he said, shit is definitely cooling off now. It's definitely cooling off. But, not cooling off doesn't mean that we see a crash. It just means that you see a curb in demand. Obviously, that's what rate hikes are designed to do. In January, you could have gotten a house with a 2.9% mortgage rate. That same mortgage rate now in the 30-year is 6%, right? So you're paying double in interest what you would have paid just a few months ago. That is the fastest hike in the 30-year mortgage rate that we've ever seen. Make sure Tom Nash takes a COVID test. Dude sprays out of mouth like you guys are relentless. Don't be fooled by this temporary rally. Eternal's fiend. We talked about this already. Nobody's fooled by this temporary rally. But by God, if I don't fucking trade it, and thankfully we did trade it successfully. It was a pretty easy thing to trade today. The VIX is down 14%, like clockwork. I said every single meeting, FOMC meeting in 2022, we saw a tanking of the VIX because the Fed is really good at telegraphing and then announcing what they already telegraphed so that there are no surprises, which means that the expectation and volatility drops. So, yeah, it doesn't mean that it's the time to buy or whatever. All right. Why are the stock market and cryptos going up? Oh, my God. Rewind the tape. It's because the Fed announced what was already priced in. You were on point with the way FOMC should play. Appreciate it. Do you think we drop tomorrow or rally for a bit? I think volatility continues to drop or at least remain stagnant. I think that the market is going to be stagnant with a bunch of up and down days until the next GDP reading at least. I think the S&P 500 maintains this bear market for quite a few until we get, if we get a positive GDP reading and we stave off a recession in the short term, and or we start to see inflation trending down. All right. Will the housing market go? Oh, we already talked about this. Do you think it is possible to have a Fibonacci added the real value of the price discounted by a real rate from the Fed? No idea what you're talking about. Markets are acting more schizo than my ex. Z, don't even read those low vibration comments. Cyber, let it go. Yeah, I mean, for real, Omar, you are on one today, bro. Do you think the 3x leverage TQQ is a good option buy? It might have been a good hedge for today. Expecting that the Fed announces what was already priced in. I don't think it's an optimal play going forward, especially since the S&P 500 officially hit a bear market. So yeah. You from LA? Yes, I'm from LA. JT, I'm late. Hello, what's going on? All right. A lot of people can't afford 6% APR. Yes, I mean, Andrew, that's the point. That's the point of raising rates. So shit is more expensive, so people stop buying shit, so prices come down. Z out here hustling in these YouTube streets. Yes. Thoughts on Goog split? Same as every other split. The dumb money is going, the smart money is going to prop up Google before the split. And then on the day of the split, all the dumb money is going to buy in and they're going to get dumped on. And, Google will drop on the day of the split and following. We played this exact same shit on Amazon. Look at this. So on Amazon, and I had sent this out in the Discord as well. And this play was down 90%, but I stayed in because I had high conviction. I said I was buying the 2,000 put expiring June 17th as a hedge against my shares for the split on June 6th. So post-split, this was the $100 put. We ended up closing those for a max of 350%. Because same shit. This is all just trend-based data. And again, it's important to base all of your plays on data. So if you look at the split, the day of the split here, you see Amazon dropped all the way to around 102, 101. It's because I looked at the Tesla split and the Apple split beforehand. So, I figured that the Amazon split will play the same way. And I figured that the Google split will likely play in a similar fashion. You can already start to see that Google is up 4% today. We're going to get a rally until the split day, which is July 18th. And then the dumb money will get dumped on by the smart money who rallied this up until the split day. And then the dumb money thinks that they can buy on the split day and somehow become millionaires. They're going to get dumped on. Google's going to drop, 15 to 25%, just like every other mega cap after a split. So it's a fairly easy cycle to play. All right, let's see. How much percentage of cash balance required as a security to sell a cash secure put? You need a margin account to do it. And you're going to need about 30 to 40% of what it would cost to buy 100 shares of that stock. How can Fed avoid Volcker recession? A lot of people think the Fed cannot avoid a recession. So who knows? That's the talk between, the soft landing and a hard landing. Basically, that just means, can the Fed avoid a recession? A lot of people think they can't. Bear market average is around minus 35%. We got more downside. Yeah, I think we'll hit at least that 30% down. You think they want us to add money so they can bag hold us? Not sure what that means. There was an 8% pump during the week before Amazon. Do you see? Yes, I just talked about it, Salaryman. We will see a pump before the split on Google, and people will get dumped on because they'll try to buy on the day of the split. For some reason, dumb money cannot avoid doing that. Are you Hawkeye's stunt double, Nicole Money? That is the first time that I got a Hawkeye reference. I've gotten a lot of lookalike references, some of them hilarious and way off, some of them surprisingly close. Hawkeye, that's the first one I got. I think I'm a little too brown for Hawkeye, to be honest. Because was it Jeremy Renner? I don't look like Jeremy Renner. Come on. How about Shop split? I don't know. Honestly, I don't know. Shop is not a blue chip. So, dollar store Hawkeye. Yeah, that's what your mom said, Jibba Jabba. That's why she keeps calling my phone. Bag hold does mean we all invest today and next week we will all be red. Again, not sure what you mean, West Beats. Why would you invest today? Rami Malek vibes. You know what? I've gotten that before. When is the best time to buy your puts when a stock split comes? Probably on the day of the split. What does a split mean long term? Absolutely nothing. A split just means that you get more shares for the amount of shares today, but the price also gets divided by the same quotient, right? So a 10-for-1 split means that you get 10 more shares for every share that you own, but the price of the stock also gets divided by 10, so it makes the stock cheaper. It has absolutely no repercussions on the fundamentals of the stock or the market cap of the stock or the value of the company. All right. What do you think of proponents of there being a melt up in the markets? Yeah, I think there can be a melt up in the markets. If there is, if enough people in the markets think that inflation is controlled and that the Fed can control inflation, you will see a melt up for sure. What do you think of the market after today? I talked about it for an hour and a half. Rohit, rewind the tape, please. Morgan Spector, great actor, Gilded Age. You look more like him than Hawkeye. Who the fuck is Morgan Spector? Okay, you know what? We're gonna look at this. Morgan Spector. All right. Fine. I won't argue with this. All right, I guess. That's a first for sure. All right, let's see. How's the Ducati? I sold the Ducati. I got an Aprilia. If you follow me on Instagram, you would know. Much love for you, Z. Keep up the good content. Thank you, California, man. Thanks a lot. I am dead. Your answers kill me. A split has a psychological effect. Yes, but not an effect on the company. All right, let's see. Do you think Google can touch 1100 when S&P hits 3500? No. What are you talking about? 1100? The motherfucker's trading at 2200. No, I don't think that's going to happen. Are you Egyptian? No, I'm not Egyptian. SoFi reverse split. Is this good for a company? It doesn't matter, guys. It doesn't matter. All it is them just trying to alter the stock price for psychological effect. Has nothing to do with the company. SoFi is reverse splitting because it tanked to the ground. I hate SoFi as a company. I've talked about this before. Because, especially with the talk of canceling student debt and, making college free or whatever, or affordable, that's not good for SoFi's business model. Shades from Luke Cage. Oh my God, this is getting ridiculous. Who's shades from Luke Cage? You think I look like this motherfucker? This is very disappointing. Oh my God. I do like these comparisons though. When Z swears, you asked something outlandish. You are smart, live smart. Thank you. Do you speak fluent Spanish? Depends. I can fake speaking fluent Spanish. I definitely understand Spanish more so than I can speak it. But yeah, I mean, I can get around. But people can tell, like if I'm in Spain speaking Spanish, people think I'm Mexican, but it's because I grew up learning Spanish, in LA. Zaddy, let's see them pecs. Come on, man. Chill the fuck out, dog. Subsy, long time, almost 1K peeps. Nice. Yes, guys, hit that thumbs up. Do me a favor. Hit that thumbs up so that people find the stream, for the love of God. All right. This chat is getting out of hand. Pomade. Omar. Come on, man. Don't make me put you on blast. All right. What do you use for your hair to be so shine? Oh, that's what you were answering? Yeah, pomade. That's right. You look like Ryan Reynolds with a beard. You guys are coming out of the woodworks here. Are you Persian? No, not Persian at all. All right. Next comment is if you guys are fucking wild. I think the guys are crushing more than I am. I mean, that's always the case. Do you have any friends in California? I'm from California. Yes, I better have friends. I'm here in California. I think you look like Tom Cruise. Shut the fuck up. Is SQQ could be a good buy. I mean, what do you mean? Like for the long term? For today? For a day trade? Hi Z, are you multiracial? You look Ethiopian? Really? I mean, you do have the Amharic lettering in your name, so I will respect you. I will respect your opinion since you are probably Ethiopian as well. Leave Z alone. He looks great for 50. Hey, Art, don't make me come back on you, bro. All right. Let's see. Do you think the negative GDP numbers in July can cause the market to crash? I talked about this. I do think that sometimes the GDP is a lagging indicator, unless we're in a dire situation like 2008, in which case there can be a sustained bear market from the fact that we're in a recession. But a lot of times recessions do last a short amount of time. And by the time a recession is announced, we are closer to a bottom. So it really depends on what's going on with the economy. Is inflation starting to get under control? Is the CPI starting to drop? Is there any, risk such as defaults in home loans or other credit instruments? That's going to determine how fast the recession is. All right. Thought you were from NYC. No, I'm from California. I do spend a lot of time in New York, though. And like I said, I will be there in a month. So for those of you that are in New York, want to hang out, hit me up on Instagram. We'll grab a drink or play hoops or whatever. All right. Are you from Algeria? No. What's up with these race questions? I know, Grizzly. I think it's because I'm racially ambiguous, so people are very curious. I bought Google before the recent market dump. Should I see shares when the dumb money pumps and then I rebuy? I have no idea. What do you mean, should you see shares? I have no idea what you mean, honestly. Are you Cuban, Dominican, or Puerto Rican? I love how you try to use like a catch-all of Caribbean, Spanish-speaking countries. Very good guess. Good to see you, man. You look like Matt Barnes. Okay, I got that quite a few times. Do a meetup soon, Z. You do not look like Morgan Spector. Fucking thank you. Do you like Bill Gates? Weird. I don't know Bill Gates. I respect, when I look back at the tech companies that have, boomed in the 90s, Apple, Microsoft, etc. I definitely respect those companies' rise to dominating market share in these new industries. But I don't know Bill Gates personally. I respect his business acumen, I guess. All right. Since we're in a downtrend, do you think buying a put on guys, what is it with like these random option plays? Okay. If you're just like looking at the market and saying, oh, it's up today, I'm going to buy a put on TQQQ just for no reason, without there actually being levels like what we draw out and highlight in our private trading group, without you actually coming in here, drawing supply and demand zones. If you just want to buy a put just because, I mean, fine, be my guest. But you're probably better off studying a chart and, making your decisions based off of this. Would I buy a put here? Not really. Not with this volume that we've seen here, this green volume that we've seen here, after the market has hit a temporary bottom after this 3 red crows pattern that I talked about in my previous video. Also look at previous FOMC meetings, right? Like look at the one that we had in May. We had 1, 2, 3, 4 days of run up after the FOMC meeting. Look at the one that we had in March. Was it March? I can't remember. March 15th, 14th, 15th. We had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 positive sessions after that last FOMC meeting, right? Just think about this stuff from an empirical standpoint. So if you look at that, at the last FOMC meetings, and you look at how the market reacts after the FOMC already deploys what has been priced in, then you're going to be in a much better position to make decisions. I would not buy puts here. No, not at all. Especially look at this volume here. Look at this violent green buying volume here. This is likely the market or, institutions or market makers going to temporarily pump this market up to make a little bit of profit in the next few days. So I personally would not buy a put here. There's a reason that I bought puts on the VIX here. Again, it's because I based it off of historical data. And I do think that the VIX will likely continue to drop the next couple of days because I don't expect any surprises, right? So, don't just buy a put because the market rallied. MACD showing selling pressure though. Okay. On what? It's showing selling pressure on what? The 1 day? I don't see selling pressure on the MACD. The MACD just looks like a regular lagging indicator here. Now, if you're looking intraday and, you're trying to make intraday decisions, fine, of course. If you're looking to buy put on TQQQ, and say you're looking for it to, I don't know, fill this gap here, for instance, at the $23.50 level or something. Okay, cool. But if you're just looking at a daily chart and you're like, oh, the market is up today, so now I'm going to buy puts. No, look at what happened the last few FOMC meetings. Again, it's all about optimal trading. It's not that you can't be right, man. You can definitely be right, and you could definitely probably make money if you are right. It's about taking optimal trades versus non-optimal trades. That's it. Do you usually trade all of your morning level callouts? No, the ones that actually make it. When we do these options day trade, watch us. And by the way, again, we send this out every single day in our elite trading group. And if you want access to the elite trading group, apply using the link below because we've closed the regular mode of signups. So that already went away, and we are now taking applications. But when you look at this stuff, yes, I mean, if it's confirmed, if these levels are confirmed, then you trade what you can. Obviously, I don't get to every single one every single day. Realistically, you're going to get to 1 or 2, if you're lucky, 3, but not if they're all happening at the same time, right? If they're happening at different times, then you might be able to finagle it. But, most of the time I'm getting in, 1 to 2 of the list, and I'm happy with it because they're optimal trades. They're based on, sound technical analysis. I only enter if there's a confluence of indicators that I use every single time and I never deviate from it. I don't play using hunches, right? And usually those moves will end up, making me a good, usually 40 to, if we're playing 0 DTEs, over 100% on those plays. So I'm usually happy playing 1 or 2. I'm not trying to force every single trade. Hopefully that makes sense. All right. I have a position that recently lost 400%. Should I exit? Shafiq, you and Omar are on one. Your background is of Chinese descent. Yes, you're right. Tesfa. Tesfa's an Ethiopian name, isn't it? Or Eritrean, one of the two. Do you ever sell shares from your long-term portfolio to realize profits? Not really, unless I'm making major changes. So I talk about this all the time, but back in the mid to late 2000s, oil companies were the biggest market cap companies in the world. Tobacco companies as well. So, obviously there's been a shift since then to tech. If you're making those kinds of shifts, yes. But if it's just like, oh, I need money, I'm going to start selling long-term positions. No. All right, let's see. Are you from Earth because you look like an alien? Oh, angel? Fuck off, dude. Z, are you vegan? No, not even close. If you see me at a Brazilian churrascaria spot, I would offend a lot of vegans. I've been actually, you know what? When I went to Rio a few years ago, I was talked to by the manager of a Brazilian barbecue joint because me and the group of people that I was with just kept eating the meat and not any of the carbs or salads or whatever. And apparently we crushed pounds and pounds of meat where they're like, all right, you guys need to stop eating. All right, let's see. All right, let's see. How do you feel about the feds? Didn't do enough of a job in 2021, and now they're trying to play catch up. That's how I feel. Do you use Elliott waves? No, I don't. What's the average profit you get on your option plays? It really depends. On zero DTEs, you can easily get near 100% or more on those plays because they move very violently. On regular day trades, I would say anywhere between 40 and 70% is very common. On spreads, it's quite different. And then on, longer term puts like the Amazon one, we yielded 350% on those. When did you buy the VIX? Yesterday. It was in the alerts, Curlin. Right here, fam. VIX. Right here. Yesterday at 10:07 a.m. West Coast time. Buying the VIX 30 put. FOMC, blah, 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 blah. We've seen the VIX drop heavily after every FOMC announcement this year. The Fed already telegraphed 75 basis points. We are seeing a bearish Harami pattern on the VIX right now. And if all goes according to plan, it should drop below 30. Lo and behold, the VIX is below 30. So call me fucking Nostradamus. But no, really, it's just based on analysis. That's all. But it was yesterday. If you're in the Discord, you would have known that. Sorry, I'm not in the trading group. Oh, all right. Well, I don't know what to tell you. All right. So you guys are now asking the same questions over and over again, and then a lot of off-topic questions. Bro, thank you. I've been killing it with the day trades. Rhythm fingers. Thank you, brother. Wasn't that a song from Judas Priest called Me Nostradamus? Yes, I think it was, Led Zepp. Hey, how do I join your Discord? Check the link in the description. Just go to thetravelingtrader.com and join now. You have to apply to join. Fogo de Chao, top notch. Yes, we have a few here in LA too, but the original one is actually in Brazil. It's not an American restaurant. It's a Brazilian restaurant. But yeah, it is very on point. Love your option scores. Appreciate you, Nico's Pizza and Deli. Z, what do you think of the Supra BMW Z4 Mix? Not my favorite car. Would it be a good idea to set a trailing stop loss for the long-term portfolio to prevent? I think you're very, 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 very late here, W. Very late to start thinking about selling off of your long-term portfolio. Like, as late as one could be. This is not the time to start thinking of selling. You're going to probably sell here. We'll see a bear market rally. You're going to shoot yourself in the foot. You're going to then try and buy the stocks back. Then it's going to decline again. Trust me, you're going to get into that mix. We need a halali pattern. Oh, as opposed to a harami pattern? Nah, man. We got to keep it harami. How much do you think the NASDAQ and S&P 500 will drop further from here? I think NASDAQ will hover around here. S&P 500 will definitely get to 30% in my view. Love your Discord. All the coaches are very good and helpful. Appreciate you, Venus Ray. How much money should I set aside for options plays daily? It doesn't matter, Suresh. The amount of money doesn't fucking matter. It depends on how good you are, how much you have practiced. You could set aside $1,000, lose it all. You could set aside $100,000 and lose it all. The amount of money has nothing to do with it. Did you practice? Did you learn these strategies? Are you paper trading? Are you documenting your trades? Are you looking at how options premiums move and why? Are you looking at what delta means, what theta decay means, how options react to implied volatility? Are you looking at volume and open interest? You can set aside as much money or as little money as you want, and you could lose it all if you don't know what you're doing. You want to raise my RS3 with your MX3? I don't have an MX3. I have an X4M competition. Other countries' stock market are meltdown is. No idea what that means. What about in the future when we exit the bear market and start a bull market run? No idea what you're asking. Guys, no idea. Off-topic questions because you were smart and good around the information you offer, so you become more interesting personally. And the Shatra B says, that is quite detailed analysis. I will accept that. Thank you so much for that. Mohammed Rashid from England. Ever since you got better at trading, do you open more positions or less? See, these are the types of questions I like. Amir Penkar, very good fucking question. This is such a good question. Ever since I got better at trading, do I open more positions or less? Definitely less, but definitely bigger. Does that make sense? So the position size is definitely bigger, but less positions, because you want to be able to monitor fewer positions, and you are very diligent about the types of setups you take. They're much more optimal, right? Again, you can make money trading anything. It does not mean you should trade it. You should only trade optimal setups. So in this case, I'm only trading optimal setups, which means I take fewer trades, but the percentage or the amount of money of each of those trades, because I have a higher conviction in them, has increased since I've got better at trading. So I used to trade, every position was 0.5% to 1% of my portfolio, every options trade, right? Very, very small. The better I got at trading, I opened that up, right? So now I'm about 3 to 5% of my portfolio on every options position, but it's a much fewer number of positions. Brian Hooker, I'm part of the Discord. Nice. Welcome. Z, appreciate your time for us. Thank you so much, Sonar. Thank you. Appreciate you. All right. Oh shit, the market closed. All right, guys. I appreciate you. I love you guys, and thank you for joining these and making these always interactive and fun. I love these. Hopefully you got something out of this. Hopefully I summarize what's going on with the Fed in a very concise way, and that's easily digestible for you. Again, we've closed our signups to the private trading group, and we have started a new application process. You can see that in the travelingtrader.com, or basically just follow the link in the description. Same thing. But yeah, guys, I will talk to you soon. For those of you that are in the Discord, I will see you. Appreciate you guys. Stay safe out there.